should investors be hesitant investing in a hot market? And as many of you know, the way I answer that very simply is no. We can't time markets. You should never try to time markets. I understand that the market is at all-time highs, but now's the time where good investors, investors that do their homework, that do their research, you will find and continue to find those investment ideas that are still relatively cheap. And in those investors that try to time this market, go to cash, sell out of your winners, sit on cash and wait for that pullback. Those are the investors that end up not making as much in with respect to returns as other investors that just keep their money in the market. But yes, you can move it around. You can trim your winners. You can buy some of the names that have not moved up as much as yet. Or perhaps you want to buy some of those names that have pulled back for reasons that aren't, in my opinion, valid and that perhaps have nothing to do with that business whatsoever. We see it all the time. Geopolitics. When the political environment is negative, stock market tends to pull back. But that has nothing to do with how Meta is doing. That has nothing to do with your shares of CIBC or TD Bank or CN Rail. When the political climate is negative, unfortunately, investors are negative and they pull money off the table. But that tends to be a good buying opportunity. Buy the dips, as we say. That seems to be the motto for many investors over the last bunch of years. You buy on the dips because this economy in the United States, I should say, their economy is doing extremely well. Our first chart actually is made up of two charts. And you can see here on the left side, good days in the market. Well, if you're somebody who's pulling out of the market and not sure when to get back in and you're trying to time this market, you can see when good days happen. Most of the good days, 50% of them, happen during bad markets. So if you're an investor that is trying to time this market and pulling out of a market that you may think is going to become difficult or is already starting to be difficult, you might miss on half of the good days of the market. And you could see that during a bull market, 22% of the best days are during a bull market. And during the first 2 months of the bull market, you could see that even a little bit more, 28% of those good days. So never a good idea to try to time markets. And what I tell people is, yes, we're always waiting for that shoe to fall, that the stock market to fall, and you're just not sure when that is going to be. However, what are you going to do? Are you going to wait on the sidelines and just have your money in cash and watch that market go higher and higher each day? And then eventually, yeah, you will be right. But perhaps you leave 15%, 20% on the table. And yes, maybe the market then pulls back 5 or 7%. So the average investor that stayed in the market makes 13%, 20, and then they lose 5 to 7. Whereas the investor that pulls out of the market maybe keeps half their money in the market. They don't make as much, but they're still in for the losses as well. So my advice is the bad markets and the difficult times will always happen. What we want to do is we want to take advantage of the good times. Take advantage of those good times when they're here, like now, for example, and then minimize the loss when markets are more challenged and in difficult times. And I think if you can do that, that is the recipe for success. If we can just bring back our chart again, we can show on the right-hand side of that chart, you can see if you're fully invested, that is the best way to be for all days and not try and time the market. You can see what $10,000 would grow to if you invested from 1995 to 2024. This is basically just under 30 years. You could see how much you would have made had you missed just the 10 best days. You would make 54% less. Had you missed the 20 best days over that 30-year period, just 20 days, 20 best days, 73% difference, 73% difference in the person who stayed in the market versus came out. And obviously, if you missed the 30 best days, you 83% less at the end of those 30 years than you would have had you stayed in the market. So very important not to try and time this market. We want to stay in this market. We want to move things around. We want to take some profit and keep investing those profits into things that have not gone up yet. But that is the strategy to use, and not take your money fully out of this market and wait for better days ahead.